Let's bring in Craig Moffett and get an update on American media, cell phones. Which toy are we buying right now? What's the hot toy right now?
Hey, how are you, Tom? Good to see you again. The hot toy is smartphones. Smartphones and tablets.
Everywhere.
Smartphones and tablets are everywhere, and there's a bit of a froth around especially the smartphone economy, with the idea that everybody is going to have a smartphone. Every smartphone comes with a $40 data plan, and therefore this is a rising tide that floats all boats.
But an iPhone costs $600, I was told.
There's the iPhone cost. There's tablets, which are not cheap, and I think you were talking about the ISM numbers and employment. I think it has to be taken into account when you think about how deep the reservoir is for all of these different products.
Let's look at dreaded first chart, and here's the key question with you in the short time we've got with you today. Media in search of total return. Okay, there's the boom. We come down, crisis, and we've come back. Is anybody making money at this, or did they compete away the profits?
Well, you use the term creative destruction, and I think that right now we're still in that creative destruction phase, with emphasis more on the destruction than the creative. There is more value destruction right now than there is value creation out of all this.
Well, continue with that. Well, who's being destructed the most?
Well, right now, look across the entire value chain. Start with the carriers that I cover in the telecom space, right? They are gaining from those incremental revenues associated with smartphone data plans. But on the other hand, there's huge deflation. So the capital spending required to support that is growing much faster than the revenues, and therefore you're actually seeing falling return on invested capital.
You and I could have had this same conversation 20 years ago. When does this end?
You're exactly right. In telecom, it is a perennial conversation because history says telecom markets are very deflationary, and therefore you tend to get falling returns through all these new cycles.
You have a great quote to lead off one of your research reports. This is the philosophical Moffett. It's not what you know you don't know. It's what you don't know you don't know. That's on the edge of Popperian theory there out of London School of Economics. But I like that. What do we not know that we not know right now?
Well, what I was referring to in this was that there is so much scrutiny to the wireless business inside the telcos that the potential for surprises really comes from the wireline business. You know, it's funny, the wireline businesses in Verizon and AT&T are still bigger than their wireless businesses. They get very little attention, and as a result, you're prone to negative and in some cases positive surprises. Right now, I think there's actually a positive cyclical tailwind in the wireline business, but secularly, I don't think there's any question those businesses are in deep decline.
Here's a chart. This is the Moffett was right chart. Craig Moffett buys straw hats in winter. Bring it up here. There it is. Moffett buys straw hats in winter. This is just the ratio of Verizon to AT&T. And we rolled over, and just as you predicted the last time you were on, off of Verizon iPhone enthusiasm, on a relative basis, AT&T would do pretty well. That's sort of what's occurred, right?
Well, I'll make an interesting argument from here that we see more of that continue. You know, now that we've got the AT&T merger proposal on the table with T-Mobile, you know, remember what the bull case is that brought Verizon to those highs. The bull case was that you can look through 2011 and that in 2012 you'll get all that extra smartphone revenue. Now think about AT&T. We'll come back from summer vacation and investors will start to look into 2012 and they will say 2012 for AT&T is a muddy year because you've got the merger closing costs associated with T-Mobile. You've got all the one-times. Let's look out to 2013. 2013, you will have real merger synergies starting to come from that deal. 2014 and 15 even, very nice earnings growth, probably faster than Verizon, and it's trading at a 30% discount to Verizon. So I still like AT&T here.
The management of AT&T, we go back to recently Armstrong or back decades before that. Tell us about the character of AT&T management right now.
AT&T, well, they've actually turned over a lot of their management.
That's what I guessed.
But Randall Stephenson, I think, has shown himself to be willing to wait. He's done some fairly bold things, but not big deals until the T-Mobile deal. He was really the driving force behind the AT&T making the bet on the iPhone that turned out obviously very successfully.
I think that worked out okay.
Worked out incredibly well for them. Was also one of the leading investors leaders of their investment in what they call Uverse, their wireline TV business. But waited a long time before he finally made a big deal in T-Mobile. And I think T-Mobile is actually going to turn out to be a brilliant deal if they can get it done.
Switch gears just because of time. Elegant chart here, folks. Comcast and the S&P. We've shown something like this chart before, normalized back a decade. The white line is Comcast. I mean, okay, it's there, but when do the shareholders get paid off of things like Comcast? It's all in vogue now. Shareholder return, dividends. Cable TV is like the biggest cash flow thing going. When are they going to deploy to shareholders?
Well, it's funny you say that because they just reported earnings last night, and there's already some frustration because the cable business knocked the cover off the ball. And the NBC business that they just went out and bought is a bit of a muddle. Some good pieces, the cable networks did well, some not so good pieces in broadcast and film. And investors are naturally sort of scratching their heads and saying, why is it that they went and did this anyway? Because they've just diversified away from a business that's just hitting its stride. Had they used the same amount of money instead of buying NBC to buy back stock, their stock price would probably look more like Time Warner Cable's.
Michael Price sat in his chair yesterday as an investor where you're an analyst, and he said he likes the NBC deal. He thinks that they essentially stole it. Do you agree? I
think they bought it for a very good price, but there's two separate questions here. Did they time the asset purchase well? I think the answer is yes. A more fundamental question, though, is NBC worth more inside of Comcast than it was outside of Comcast? And I think the jury's still out on that. My guess is probably no. And look, the proof is in the pudding. Time Warner Cable, which has done exactly what you suggested of let's take that cash and return it to shareholders in dividends and stock repurchases, has actually been a spectacularly strong performer, at least in stock market performance over the last 2 years.
This chart quickly for Craig Moffett. Google and Disney. It's an elegant chart. White Google, that slog there for the last 5-6 years. Disney. Content is king with ads. Which matters most? Content right now by NBC or an ad generator like Google? Which is the most important?
So you're asking really sort of where's the value? Is it in generating content or is it in aggregating content? And historically, aggregator businesses tend to be extremely attractive businesses with one important caveat, and that is they are also turn out to be very fragile businesses, and so they're sort of all or nothing propositions. Right now, Google is the ultimate aggregator. It's not aggregating content; it's aggregating information. Right? It is. We will. Their motto is organizing information. That's proven to be spectacularly valuable. But there are people nipping at their heels, like Facebook, that say we'll organize around a different rubric. Instead of information, it's social networks.
We're going to have you back another time for this. Craig Moffett, thank you so much.